Well, hello and welcome to NRHA's 2013 webcast series. This third webcast in our series will tackle the topic of some questions you should ask before you make a major investment in your business. To invest or not to invest? My name is Jesse Carleton, and I'm editor here at the Hardware Retailing magazine at the NRHA, the North American Retail Hardware Association, and I'll be guiding you through our discussion today. This webcast today is sponsored by, of course, NRHA, the Hardware Retailing magazine, as well as our vendor partners. So let's get started. Our webcast today, to invest or not to invest, we're talking about investments, and we're not talking, of course, about stocks and bonds. We're talking about what should be the biggest investment that you make, one of the most important investments in your life, which is your business. This is what you use to, what you depend on to earn your living, and it's, for most of you, for many of you, it's what you will depend on to retire when that time comes. You want to build up the equity in your business enough that you have a nice stock of cash. So there's many reasons why you may want to invest in your business, and we're going to be talking about those big investments. Obviously, there are some things that you have to do. The furnace blows up and you have to fix that. The roof leaks and you're going to have to fix that, maybe replace it. But there are other investments which may be a little more discretionary. They are things when you say to yourself, you know, if I had a lot of money, I could, and fill in the blank. And whatever that is something that would make you more profitable in the future. Those are the kind of investments we're going to talk about today. And just as a few examples, maybe you're going to purchase a POS system or upgrade the one that you already have. More than likely, you might already have a POS system. Could be a big investment, but it could also make a big payoff in the future. Another investment could be maybe expanding the size of your building, for instance. You're getting tight on space and you just need to knock out a wall or two, or maybe even move to a new location. That could be a major expense. Maybe you're updating your fixtures. You want to bring a new look to your store to make it more shoppable and to appeal to a wider range of customers. Maybe you're going to buy a delivery truck and you want to start a delivery service, or you want to upgrade the equipment you already have. So I hope you all are asking yourselves on a regular basis, what are some ways that I can improve my business? Sometimes that means making a big investment in your store. So that's where our discussion here is going to start. When you make a big investment, you of course want a big return on your money. You want a big ROI. So where do you start? How do you know if this investment is going to be a good one for you? Now, just as a kind of a side note, as a disclaimer, we're not going to get into specific investments. We're not going to talk specifically about whether or not you should have, you should expand your building, you should move to a new location, whether you should buy your building. That's all going to be different depending on your individual situation. It may be, what may be good for one person is not necessarily going to be good for another person. We're also not going to talk in dollars, because that again is going to be variable depending on who you are. And of course, before you make any big decision, always talk to your CPA or financial advisor. They're going to have the best way to look at your numbers and see your individual situation for what it is and give you the best advice. So with that, those disclaimers over, what we are going to talk about though are the big overarching questions that you should be asking yourself. These are some kind of self-evaluation questions that you want to ask yourself about your business as you decide whether this investment is good. So the first question, what is the real value of my business? Basically, we're asking, is your business strong enough to handle an investment? If you're making a large cash outlay, more than likely you're going to be going to the bank. You may be just dipping into savings, but even then, you want to kind of think like a banker. What does the banker see when they look at your business? You, of course, see your life's work. You see everything. You see your day-to-day sweat and tears and your labor. You see a lot more than your banker sees, but your banker is just going to look at the bottom line. If you're going in for a loan, he or she wants to know, are you going to be able to pay me back? They're going to look pretty starkly in a different way. So this is a good time for you to look in a similar way at your business. It's time to shed your bias and think about the hard numbers. This also gives you a baseline comparison for the future. Another good way, if you know exactly what your business is worth today and what are some of those numbers that define that worth, you can look at these same numbers after your investment and say, this is what my return on my investment was. I was able to increase this number from here to here. And so getting that baseline now allows you a way to compare it in the future. So what are some numbers you should look at? As I was preparing this study, I talked with Boyd & Moore, who's president of CNRG, the Central Network Retail Group, and he's pretty much in the business of buying stores. He does that a lot. And when he goes in to buy a store, he says he looks at 4 numbers. That's sales, gross profit, payroll, and building occupancy expenses when he decides to purchase a business. Those are some of the numbers he looks at. You might look at those same numbers to try to kind of define the value of your business. Boyden also suggests looking at NRHA's cost of doing business study. And if you're not familiar with this study, I hope you are, but this is a good time to kind of introduce it. We just came out with our 2013 study, and what we do in order to get this is go through, we send out surveys to hardware stores, home centers, and lumber yards across the country and ask for their financial data. We take all that data, mush it together, and come out with averages for each of those groups. This allows you to compare your numbers against the industry averages. And so, just as an example, what's your gross margin? In this next slide, we see the gross margin for hardware stores, home centers, and lumber yards. According to our 2013 cost of doing business study, the typical hardware store makes nearly 41% gross margin, and high profit stores are just over 42%. How do your numbers compare with that? If you like to use that cost of doing business study, there's many more numbers in there that you can use to compare your business and get the relative value or strength of your business. Next question to ask kind of goes along the same lines. Can I afford to invest? The first thing is, of course, look at your cash cycle. And this may be fairly obvious. Be honest about whether you can afford to be without the money you'll need to invest. If this investment comes with a bank loan, you're going to need to make those payments. So can you afford to do that given your cash cycle? You have a lot of cash in the spring, but of course you also need to think about what you're going to save back for those leaner times, maybe in the winter, if that's the way your business runs. And a big number to calculate too is your debt to equity number. And this is how you calculate that. It's total liabilities divided by net worth. And this is a ratio indicating whether or not you're leveraging your assets to through the fullest potential. Now with debt, it's great to be out of debt, but if you're a strong business, maybe having no debt isn't necessarily a good thing. If you have no debt, it could mean that you're not leveraging all of your assets to be more profitable in the future. So this debt to equity ratio number allows you to see where you fall on that spectrum. So as we see here, a 1-to-1 ratio is fairly practical. If the number that you come out with after you do this calculation is less than 1, you may have more equity than liability, so it's safe to invest. If the number is greater than 1, you may have too much debt, and maybe it's time to pull back and pay down some of that debt or increase your profits before moving on. Also, when you're considering the question, can I afford to invest, look at your accounts receivable. This goes back to, are you running a strong business? If you're having difficulty collecting on your accounts, this is going to lead to cash flow difficulties, and of course, maybe it's time to tidy that up before going on to the next step of a big investment. You also want to look at your net worth, and again, we have a way to calculate that. You take your profit margin, you take some of these key numbers, one of which is the profit margin. You know, a good profit margin number comes from increased sales, better gross margins, and decreased cost of goods sold. Another key number there is asset turnover. What are your sales compared to what you've invested in assets? And then, of course, your financial leverage. How much are you relying on outside financing? Are you too conservative? Or are you too liberal in the way that you rely on loans? Again, if we look at numbers from our cost of doing business study, we see the average return on net worth. This kind of shows how strong you are. A good target is in the 20% range, if you can see here on the slide. Are you getting a good return on what you already have? If you're getting a good return, then it's time to move forward. If you're not, maybe it's time to think about what's broken in my business and how can I fix it. Just throwing money at the problem won't necessarily be the answer if you don't have a solid plan for fixing what might be causing these numbers. Next question to ask. Now it's time to get the big picture. Why do I want to invest? What's my vision? Why am I going to spend all this money? It's time to be honest as well. This can't just be a pet project. Maybe it's something that you've always wanted to do, but it makes no sense for your business. Well, now's the time to figure that out before you get too deep. Here are some ways that might add value to your business. Are you supporting your brand? Does this investment support your brand message that you're sending to your market? Your brand, of course, should help you be different than your competition. For example, if your brand is built on customer service and you're going to invest in employee training, well, then that's a great investment because you're building your employees' knowledge, which transfers to your reputation, your brand as a provider of good customer service. Another reason to invest might be to make a preemptive strike against coming competition. A great example is TJ Comstock, who has a store in, several stores in Montana. His main store is in Billings, and a few years ago, a independent retailer was moving in down the street, and it promised to be a big, splashy, nice, new, big store that he was afraid was going to woo all of his customers away, some of his loyal customers. So he said, now's a good time to make some improvements that I needed. He already had a pretty nice looking store, but he had some other ideas of the way he can make it even better. And he made a big investment. He expanded some of his categories and came out to be very competitive, and I don't think was affected much by his competition, not like he could have been had he not made the investment. Another thing to consider as you're investing, which leads us kind of to what we just talked about with TJ's new store, is improving your store's physical appearance. Some investments may have an indirect return, but they are just as important. Having an inviting store is one of the many pieces that helps you get people in your door. So if you're making a major investment in your store's appearance, you may not be able to measure it directly on your balance sheet immediately, in a tangible way, but you're going to realize it in better sales because customers feel more comfortable shopping there. Another way that you might want to invest in your store is to improve your operations. One of the ways we already mentioned is a POS system. Hopefully you all already have a good point of sale system, but if you don't, now is the time to invest. If your system isn't quite up to expectations or you're thinking, I need to get another one, it's likely this is going to be a pretty good investment. Another question, the fourth question you can ask yourself is it a way that I can cut expenses? And this goes back to kind of what's been a common theme here is how strong is my business and how can I make it stronger? One of the ways that you can look at are operating expenses. If we look here at these numbers from the cost of doing business study, are your operating expenses too high? There's a number you can calculate if you total them all up. We see on the CODB it's less than 40% for the high profit hardware stores and even lower for lumber yards. If your operating expense number is too high, it's time to dig a little deeper and discover why is it too high and what are some ways that I can cut to make it where it should be. Another way that we don't like to think about too much, but sometimes we just have to do is, what about our staffing expenses? If we look at, again, the numbers from our cost of doing business study, we see where the staffing expense number lies. High profit hardware stores are less than 20%. Home centers are just a little above 20%. So if your numbers are way out of line, then it's time maybe to make some difficult decisions and really think, is having too much staff detrimental to my business, and do I need to make some cuts to move forward? The final question to ask yourself is, when do I plan to leave the business? Is it going to be soon? Am I nearing retirement? Do I have plans to sell the business? That should change the way you think about investments. Your focus, of course, should be getting the most out of what you already have. You want cash flow. Again, it's time to think like a banker. It's time to think about the strengths of your business and what are the things that a potential buyer is going to look at. If you're working through a succession plan, it's also a good time to sit down with the new owner, whether it's a son or a daughter or someone else in your store or someone that you're already working with. Sit down and talk about the timing of that big investment. Maybe it's best to wait to let them do it, or at least to let them know what they're going to be taking on in terms of debt or major changes to the way the business is. It's also a time to focus on maintenance rather than replacing. So if the furnace can hold on for a few more years with just a few patches, it's time to let it do that. Or if the roof can hold on for a while with just a few patches, let the new owner's not going to want to take on a lot of debt. So it's a good time to focus on maintenance rather than repair, on maintenance rather than replacing. Well, thank you for your time. The decision to invest in your business is a very important one, and I think these questions are just the beginning of some of the things you should be asking yourself. I hope it's been useful, but most of all, I hope that you are considering the next big thing in your business. Thank you for listening, and good luck. And also be sure to join us in the final webcast of our series. It comes up by the end of the year, and it will be talking about the NRHA's annual market measure study, where you can get all the numbers and the news from the industry in 2013.